Hello, friends. Welcome to this July edition of Monthly Viewpoints. The global environment has changed meaningfully over the last few months. The continuing geopolitical conflict between Russia and Ukraine has led to an entrenched episode of higher inflation across the world. Accordingly, the US Fed and other central banks have significantly hiked their policy interest rates this year. This has led to sharp reactions across global financial markets, ranging from equity, bonds, and currency. There have also been meaningful downgrades in global economic forecasts. Narrative has slowly been shifting from concerns on inflation to growth slowdown across major parts of the world. Past episodes show that deterioration in growth and inflation outlook have presaged market corrections. Accordingly, over the last few months, we have seen the much anticipated correction in equities globally, including in India. While the Nasdaq is down almost 30% from its peak, S&P 500 is down around 20%, and the Nifty is down around 10%. Despite the adverse macro backdrop, Nifty has fairly remained resilient and has outperformed other global indices on the back of three key factors. First, inline corporate earnings thus far. Second, India's structural growth story, which puts it in a relatively stronger position vis-a-vis other economies. And third, the faith of domestic investors in India's economic growth, resulting in higher equity allocations. Lately, cooling off in oil prices has also been a positive factor for Indian markets. Going ahead, we believe that the pace of domestic recovery will depend upon the duration of the ongoing Russia-Ukraine crisis, as it will impact commodity prices and the pace of monetary tightening. In the near term, we believe that markets are expected to be range-bound with bouts of volatility. Inflation remains the key variable for global and domestic markets, and any signs of easing in inflation will likely provide a cap to bond yields and a bottom to markets. On a medium to long-term basis, we continue to remain constructive on Indian equities. We expect Nifty earnings to grow at a 13 to 15% CAGR over the next 3 years and markets to continue to scale higher from current levels. Overall, we believe Indian equity markets can give returns slightly below earnings CAGR over the next 3 years. As the economic recovery continues, we remain bullish on domestic economy-facing sectors. Our recommendation remains that investors should continue their SIPs and use any corrections to add to the equity exposure. We provide a basket of funds for investors to choose from. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।